Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Callum Thomas of Topdown Charts. Callum is the founder and managing shareholder of Topdown Charts. He's got a career background in multi-asset investment management, both in New Zealand and Australia, also with a focus on investment strategy and economics. A lot of ground to cover today. We might end up going around the world with all the charts, but Callum, thank you for taking time out today for having a chat.
Yeah, thanks for having me. Looking forward to it.
Likewise, and people that follow you on Substack and will know that the weekly S&P 500 chart storm is fantastic reading because you really do deep dive into a whole multitude of things with regards to the S&P 500. So that's probably the best place to start. What's going on chart wise at the moment with the S&P 500?
Yeah, it's a good question. And as I work to pull up the screen, yeah, I started the chart storm back in 2015, I think it was. So quite a long time ago. And it started initially as just a collection of 10 charts, and it's always 10, never more, never less. And some people sometimes say, oh, well, if there's less than 10, that's okay. And if there's more, then maybe you put more. But I always think, well, um, first of all, by saying I have to have at least 10, it's a really important discipline to have because it forces you to go and do a bit more digging if there's, if you can't find that many things initially. And so I think that's an important discipline and from a just to muse on the development of yourself as a researcher or an analyst or trader is that having those kind of disciplines is really powerful because over time, that sort of forcing of upping your game and having a certain standard that you're holding to is really valuable. And then on the other end, if you've got, if you're saying like, oh, well, these 20 charts are all important, then, well, actually, probably you still can distill them down, and the act of distilling them down is also an important discipline because it's like, okay, well, maybe there is 20 important things, but let's distill it down to the most important so that, ultimately we're saving the reader a bit of time by only by distilling it all down. And that's kind of the value of those sort of types of reports and things. But yeah, initially it was just a collection of 10 charts, put them up on Twitter with a one-liner. And when I first started doing that back in 2015, I sort of like just started the job as an investment strategist, and it was almost more about making myself try to develop my own skills and knowledge base a bit more. And then over time, it became more of a as my skills and perspectives grew, it became more of a, well, here's actually more of a guide to markets. And then, when I launched it on Substack, it kind of, and then went paid, it then forced it to go a step beyond that to being like, okay, well, now that people are paying for it, I better make sure that they're getting good value for it. And now I actually
Hmm.
have to, up the game even more. And so it's an interesting journey, but why don't we now step into well, I'll give you a quick look at what it is first. Yeah, we've got I always try to distill down to a few key points at the start, just because it kind of helps with people kind of saying, oh, is it worth reading? Or, is there anything in this that sort of looks particularly interesting that I'd want to dig into a bit further? And then I try to some weeks it's very easy to come up with an overall statement of all right, here's what's happening and here's the outlook. Other weeks it's a lot more I have to sort of talk around in circles and hedge my view a little bit. Um, which and I think this week's actually a little bit like that in a way because where we're sitting at the moment, so I'll just briefly talk to this chart here at the top there. I presume that you can see
Yeah,
the S&P. Yeah,
yeah.
yeah. So the thing though, the main point there is just, well, we've got that classic oversold rebound, the brief indicator going down to washed out levels and then turning up. And, just dwelling on that for a second, the the real technical definition of an oversold or overbought indicator is when it goes to an extreme like that and actually turns. Because you can find like initially it started getting oversold and then it gets a little bit more oversold, and you only get the true technical oversold turn when it goes down and then comes back up. And so that's a classic oversold signal there. So that's good for the bulls. But then I think the key test here is twofold. It's that 5,600 level and also the 50-day moving average. And the point that I made here is it's funny when you start talking about technicals, some people will say, oh, technicals, that's rubbish. Other people will say, yep, no, that's good. But I think for both people, the thing that you find, and especially right now, is like the argument against them would say, well, how can you trade on technicals when Trump can come out and say something that completely changes
Oh,
the game? And I think the thing that I would emphasize is that a lot of the times those have a habit of coming at a convenient time from a technical standpoint. And so if we think about we're running into this 5,600 level in the 50-day, that's I think what I would describe there is quite a convenient juncture for some kind of new excuse or catalyst to show up. Um, and I would say probably to the downside, just because of sort of the weight of things. So, for example, um, just to jump over to this seasonality chart here. So, one thing that I've done with seasonality is break it down into the typical way that we look at seasonality is just to look at, okay, what's the average percentage change across the days over the year? And you most often will see people showing a black line like that in this chart here. And it is showing the seasonality chart, right?
yes. Yeah, I can see
Yeah,
everything's
okay. Just
perfectly
just
clear.
making sure because sometimes you change tabs and it doesn't. Yeah. So most of the time they show you something like the black line there, and that's your standard kind of approach. But then if you look at sort of two basic different kind of market regimes, as in bull market or bear market, and under the bull market scenario, well, rewind. So the all years, the usual thing that people look at there is to say, okay, from about May, June to September, October, you get this kind of sideways, volatile, not very good kind of situation. That's the sell in May effect, which is it's interestingly quite strong, quite reliable effect across time and across markets. But then you look at this chart and you look at the green line, and you don't really see much of a sell and May effect there. Like for the most part, it goes up, and you'd expect that because that's what bull markets do. They go up. But if you look at the bear market curve there, you know, you get actually a little bit of stability around this time of the year. And then come May, June, you get this quite significant tendency to head downwards. And that's, you know, it's basically if it's a bull market, don't worry about sell in May. If it's a bear market, definitely worry about sell in May. And so I've, I've put up a track. One thing I will note, just as a technical note on this chart, is for the definitions for the purpose of that study, I basically said, did the market go up, as a definition of bull or bear? So that requires perfect hindsight, whereas this one uses was the market above or below its 200-day moving average, and the results are very much consistent, which is reassuring. But also this gives us, because if the S&P pops up back up above the 200, then this kind of goes out the window. But at the moment it's below, so technically, on this definition, it's a bear market. Yeah, and just to go on a little tangent, I don't think that 20% is a good definition of a bull or a bear market. It's a thing that a lot of media people would like to use, but um, and then whenever I say that, people are like, well, what is a bull or a bear market? A bull market is when prices are going up, and a bear market is when prices are going down. And you know, it's a process. It's not a percentage change. But anyway, back onto this. You know, this rebound has actually come at a period where typically you do see a bit of respite in the declines, and so you know, again, it's that whole. Well, isn't that interesting that um, you know, yes, we got you know a bit of good news and so forth, or less bad news, but it came at a very much convenient time. And yeah, now that we're heading into where that sort of seasonality starts to curve down again, it's that whole okay, it's starting to look like we're heading into a patch where it's going to be convenient, you know, or certainly maybe no coincidence that a bit of weakness comes into the thing. But yeah, and on that note too, like, you know, another reason to sort of fundamentally expect that. And the way I look at things with the top-down side of things is I'll basically look at five key variables when it comes to trying to come up with an investment view. And so one is valuations, the other is monetary conditions, the economic cycles or earning cycles, and then sort of tactical stuff like sentiment, positioning, and technicals. And so if you think about what we've talked about so far in terms of technicals and seasonality, saying that, okay, maybe we're going to hit our head on the ceiling soon. To take that a step further, you have to think about, well, what are the other things that we can think about that will actually fill out that picture and raise conviction? So I didn't include valuations this time, but you know, valuations are still pretty high. And you know, the reset that we did get, it was only partial, and it's kind of that reset's already unwound, so we're still actually pretty close to the top. And a lot of sort of market cycle indicators are still, you know, in that rolling over phase. They're not come all the way down yet. But on the macro side of things, we've got like you know, the soft data has been really surprising to the downside. Hard data has been surprising to the upside, you know, so your activity data. But I would reconcile that by saying, okay, that's probably one, maybe people have set their expectations just a little bit too low, and so it's easy to surprise against that. But probably more to the point is that, you know, some of the hard data is getting skewed up by a bit of tariff front running and various other distortions that are going on there. And then, you know, just the plain old eye of the storm effect that, you know, your soft data, well, your stock prices move first, then your soft data moves, and then your hard data moves after that. So, you know, with the sort of delayed impact and, you know, with companies themselves saying that, you know, they're talking more about, well, they're talking less about things getting better and stronger, talking more about things getting worse and weaker. And the whole delayed effect of tariffs, you know, um, yeah, the eye of the storm effect could definitely be in play there, and you know geopolitics definitely um, there's a few hot spots there that are not really looking so great as well. Yeah, so I think I would be um, yeah, and it's an interesting point too, just um, to think about the moment we're in with this rebound is that it's kind of interesting from a psychology standpoint, if you think about bulls and bears, is that both are kind of like both can kind of claim to be right at the moment. Um, you know, so like I mean, if we smash through 5,600 and you know get back above the 50, um, then you know obviously the bears are basically wrong, or at least momentarily. You know, they'll be definitely not feeling so great at that point, and the Bulls will be emboldened at that point. But you know, at the moment, you know, both are kind of like in this sort of twilight zone of we both think that we're right at the moment. Um, so it's an interesting dynamic. But then the other thing too, just to balance it out, is because you know, even if you've got a view and you think that you built it up on, you know, fairly strong foundations. You know, it's important not to get too bogged down into that. And from a um, the way that I approach these chart packs is that I try to bring balance into it. And you might be sitting there with a bit of a bearish bias and outlining this scenario, this pathway, but then you've also got to consider what could go wrong with that, or what can what might well, how can this go wrong? Because failure is always an option. Um, if you spend any time in markets. Um, and one is just the way that sentiment is. Um, And there is a bit of mixed signals on sentiment. So if we look at this survey measure here, this is a combination of the Association of Individual Investors and the Investors Intelligence surveys, and you can clearly see it's very one-sided at the moment. And the way that I think about sentiment is it represents a lot of minds that could change if they had the right reason. And so that's an important point there is that, that snapping back up will be represented in price, also snapping to the upside. And then the counter argument to that, maybe counter argument is that the crowd sometimes does get it right. Like back in 2008, everyone got really bearish earlier in the year. Then you had this big old bull trap there, in hindsight, what was a bear market rally. Um, and, sentiment did actually snap back and then only to revisit the lows there. So, and I think if I had to jump off the fence, I'd say I think there's a reasonable chance of that just due to the sort of confluence of all the different cycle indicators kind of rolling over. And then, just another version there of, a jump in the number of people expecting negative returns for stocks. Um, Against that, and again with the mixed sentiment signals, is retail is still busily buying the dip, but I think you know and sort of try to reconcile those different pieces is that there are different cohorts of um, people in the market. Like, I mean, I think that this would be a small percentage of very active um, sort of the new breed of traders that have come through over the last few years. Especially after 2020, that kind of brought this new generation into the market. And whereas I think these surveys, well, one being that they're consistent across just about every survey you look at, it probably represents a maybe an older cohort or perhaps a larger um, silent majority kind of thing. Yeah.
Yeah, there's a lot of I should have pointed out, sorry, at the start to people listening, if you listen to this on podcast format, I'd highly recommend you go and look at the video because again, a lot of these charts are screaming different things. I mean, that bullish surveyed sentiment that we're looking at right now, I mean that where we are at this present day, that looks about minus 3.5-ish at the moment. And that if you look at where that was now to where it was, even just 18 months
Mm.
ago. That's a massive difference. So I should have said that at the start. My apologies. For those listening on to the podcast, I'll do my best to interject where I can, but ultimately, I'd highly recommend you go and look at this, watch the video, because again, we're going through, or Callum's going through all of the charts as we speak. So we're definitely in interesting times at the moment. One chart that I thought was really, really good. I'd like you to bring it up on screen if you can. Was
Mm.
the the money market funds. So basically, the amount of people sitting
Mm.
in cash. So if we can go to the chart, that'd be great. But also, again,
Yep.
from your experience in your years of doing this, why would people in this environment, why would people be sitting on cash? And what is this chart showing us ultimately from a 30,000 foot view, so to speak.
Yeah, so well, first of all, you know, um, when you typically during these times of uncertainty and downturn, you do see a surge in cash balances, and that can itself be, another interesting and important contrarian indicator. Um, for example, if we look back at into '08, '09, there we saw a big lift, and then also following the bursting of the dot-com bubble.
Mm.
But I think well, one thing to consider on there is that if you look at the interest rate on cash versus well, cash T-bills, money, it's actually kind of decent, even with the rate cuts, but it's sort of on par with where longer term treasury yields are, but without all the interest rate risk or duration risk that can come with that. So that's an important point because and especially putting a premium on liquidity, being able to do something with that cash is, you definitely, that means that it just kind of makes sense from that standpoint. I think also a bit of hangover from the regional bank crisis that we had, you know, that was, oh, I can't remember if it was 23 or 24 now. It was kind of a strange crisis because it came and went just well, it went just as fast as it came, but basically
Mm.
from that there was you know it was like, well, maybe the regional banks or maybe the banks in general aren't the safest place to put cash. Maybe the money market funds are a bit better, and so I think there's been a big part of that, still sort of hanging in there. But it, but yeah, there is a lot of cash there, and then ultimately too. Um, oh, I don't know if I can bring it up, but the spread between the earnings yield and the cash rate, I believe that's still negative. And so if you think about from that standpoint, you know, even like I think still now, but especially heading into this year, markets were very stretched, valuation wise, sentiment wise, it had all the classic hallmarks of being late in the cycle in the topping process. And so, you know, in that situation, and people are still uncertain as to whether bonds are going to do their job as a diversifier, it makes sense to hold cash, because, you know, if you if you think about the potential gains of being able to buy in at the bottom, if you're able to do that, they're probably going to outweigh catching that last, little bit of maybe 20% even up at the, as you head into the end of the cycle. So I think, it's quite rational from that standpoint. And I think that's where we're seeing also, at least for some people, but not widespread, is the getting into gold because you know, from a defensive standpoint, I mean, there's other options, but from a defensive standpoint, you've really got cash, bonds, and gold.
Mm.
And with, people still kind of like, well, bonds, they lost a lot of money during the inflation years, and maybe inflation comes back. So there had been a bit of getting into gold, which in hindsight has been very good. Um, well, it's been last year, it was providing um, you know, it was actually helping on the way up and on the way down now. So that turned out to be quite good. But yeah, just plain old cash, the thing about cash is that, you don't have to worry about it going up or down. It just sits there. And, one example of that would be, the old legend himself, Warren Buffett, with his rising cash pile that's been, widely
Mhm.
publicized. And, you know, that's, um, that's not trying to be too clever and time the market. It's probably more of a, well, there's just no good bargains out there to buy. He's he may not be looking at a P/E ratio chart or, valuation indicator, but he just thinks, where's the buying opportunities? And so, the market when the market cycle runs its course, it kind of has a habit of taking care of that. Um, so yeah, I think there's definitely some interesting information in there, and then also on the cash front, might as well have a look at the one above there where so this is the foreign flows, and so you've seen an influx of foreign flows into treasury bills as well, which it's interesting because if you look at the flows, bond bond flows, and they had actually been for quite some time really a key driver for US equities is just foreign inflows because well one you've just got globally a sort of herding into passive funds.
Mm,
And when you think about passive at the global standpoint, US is a high and rising part of that. And so that just means that you're getting a high and rising flow just from that into US. And then also because of the index aspect, um, a lot of asset allocators have kind of been almost forced into US equities because,
mm,
if you're not, from a peer risk standpoint, if you're not holding the thing that's going up, or if you're underweight and you're underweight for maybe good reasons, that you can spell out, uh, there's a lot of herding that's kind of like, a lot of, you'd be surprised that a lot of asset allocating, investment committee meetings, they spend as much time saying, well, you know, what actually makes the most sense for us to be going into. So, but then tied in with that too is you know every time you get a dollar going into US equities, that's a dollar of demand for the US dollar itself. So
mm,
and that's you kind of had this upward spiral of uh, foreigners buy US equities that puts upward demand on the US dollar. And so from their standpoint, if the US dollar goes up, their returns also go up. And what you find from a investor behavior standpoint is whenever historical returns go up, flows go up because you get this
mhm,
chasing thing, which often kind of does work. That's kind of how you get momentum effects as well because it becomes self-reinforcing. But you have this effect, and because their returns go up, they buy more. US dollar goes up, and so that the breakdown of that we've seen this year has been a key part of why the sell-off's been so significant. Why you've seen a little bit of performance rotation from US to global, and also why US dollar is coming down. And I've been sitting there saying US dollar is at risk. It's overvalued.
mm.
The yield support aspect is starting to fade. And around the start of the year, sentiment positioning was very much consensus bullish. But that's all been thrown into disarray because, well, one year you've got, the chance that US has a bit of a recession. But I think the bigger thing is just the whole, okay, we've got the chaos effect. Maybe we need to actually price in a bit of a governance premium into the US markets now because of, just how chaotic and things have been and how, look, it is a trade war and, it's an economic war that's being waged at a time where a lot of countries are, a lot of relations had actually been at all-time lows to begin with. So, that definitely throws a spanner in that works. And so, I think that I do think that, that we're probably seeing just the start of that definitely has room to run. I mean, certainly from a multi-asset investment standpoint, strategy standpoint, if you look at um, global stocks versus US stocks, there's a massive valuation gap there.
Mm.
And, big reason for that is just because the earnings factor, it's quite rare that you'll see valuations go into extreme expensive levels without at least some initial good reason for that. Like, why are tech stocks so expensive? Because, you know, they're good companies. and they've had a big structural uplift through disruption and market share gains. But ultimately, um, if you overpay for that, yeah, yeah, nothing can help you internally. It also kind of represents a consensus view. Like, you say, well, valuation is expensive, yeah, but it's because of this, and that becomes the consensus narrative. And then, if you have recession, that actually you find how um, cyclically sensitive earnings still are, even if you thought they're structurally rising. And then, just if you think about valuation, sentiment, confidence, they're all kind of tied in together. And so, if everybody's all thinking the same, then that doesn't leave much more people left to kind of get on board with that. And the moment people start to change their minds, things can move significantly. Mm.
Yeah, no, it's understandable. I think it's a lot of that, or if not all of that, is investor psychology, as you've touched upon already. Callum, one other chart that I think would be worth looking at, and this was one of your bullet points in the recent chart storm, was that, and we've spoken about this a lot already, but it's economic sentiment is catching down to
Mm.
investor sentiment. I was wondering if you could bring that up, and again, for those people that might not be overly, familiar with those terms, what is this graph, or sorry, what is this chart showing us? 'Cause it looks pretty damning from what I can see on the
Mm.
screen.
Yeah, and it does need a bit of explanation. It's funny, um, sometimes I forget to explain things. I'm like, I know what it means. Everyone else must know what it means. But somebody did ask me in the comments, and so I did explain. So the black line there is it's it's an average of a bunch of different surveys, and so the point there is to try and give a broad um, overview of where sentiment is on the economy. So that includes the ISM manufacturing survey, the non-manufacturing, the NAHB, the housing market sentiment, consumer sentiment, broader economic sentiment, small business surveys, and the Philly Fed in there as well. So, and the point of that is that, you've got housing, you've got consumer, small business, big business, services, manufacturing. You kind of got everyone in there, and by giving each of them an equal weight, um, basically it'll only really move if everyone's kind of saying the same thing. And so if everyone's saying, things are not great, then things are probably not great. And if everyone's saying that things are great, then it's um, probably reflective of economic activity, and it tends to be, sometimes with a bit of a delay. But because it is a survey, people can feel different than what the activity is. So, for example, in 22 to 23, it stayed very low, and yet a lot of the sort of standard economic indicators said, well, we didn't have a recession there, we didn't have a slowdown. But you know, in real terms, like in nominal terms, people were, seeing rising stock prices, rising house prices, rising incomes. But in real terms, they were either simply not getting ahead or falling behind. And that obviously, it's hard to get too optimistic when you're in that kind of scenario. We did see that initial surge there, and a lot of that was, I think, sort of narrative based, like, oh, Trump's going to come in and it's going to be pro-business, and here's all the different things that they're going to work on. And also, by the way, back in 2016, we saw actually things did get good. Um, and just to go on a little bit of a tangent there, one thing that I was talking about late last year was, okay, hang on a minute. This is not 2016, 17, because back then markets were actually cheap. The stock market was actually reasonably priced back then. We were coming out of a little slowdown. Um, and you had these things like corporate tax cuts, were you know very much bullish for stocks. And at the time, people actually were quite the sentiment was actually quite low in 2016. And so you know then heading into the end of last year, things were overvalued, sentiment was overhyped, and then also you looked at actually some of the policy set that they were talking about, government efficiency. What's that? That's ultimately that's spending less, and idea, the goal there was to bring the deficit down, right? And so what is that called? That's called, for economists, it's called negative fiscal impulse. If your deficit is smaller this year than it was last year, that means you've basically you imparted a headwind on the economy. And meanwhile, the Biden era policies were quite fiscally stimulatory. And so, you sort of have that double unwind there. And so that's one reason why, going back to the whole why are we a little bit cautious on the macro outlook, that's one reason.
Mhm.
And then of course, like it was a surprise in terms of how it was implemented, but you know, the the fact that tariffs were going to come, it shouldn't have been too shocking to us given that how much it was talked about. But when you have all that going on, you know, I talked about it then as a kind of reform-like
Mhm.
set of things. And so, the way that reforms usually work is that you have short-term pain for long-term gain, or certainly long-term change. And, you know, that's the reason why we call them reforms, is because they're painful, they're not easy, and nobody really politically wants to do them. Um, otherwise they'd be called forms because they'd already be in place. And so that's kind of, and just to reiterate the context that we're sitting in here, and why we should be cautious on the macro outlook. But going into this chart, so the black line there explained that that's how people are feeling about the economy. The red line there is basically how people are feeling about markets.
Mhm.
And so that's basically the same indicator that we looked at earlier there, but just on a rolling average, monthly average there. And yeah, you can see that over time they've mostly traveled kind of roughly in the same direction, mostly together. There was a slight, um, like investors were ahead of that big shock in 22. So sentiment did drop down, and ultimately economic sentiment came down because, you know, even though we managed to technically avoid recession, there was a slowdown there. There was damage done. The market did go into basically a short-lived bear market, and then we did actually kind of turn the corner there. Um, and so the thing to focus on at the moment there is we're again at that situation where investors, the stock market, its job is to be forward-looking, to try and anticipate things that are going to happen in the future. That's why sometimes it gets it wrong. Sometimes it gets it overreacts or underreacts, and then economic sentiment. I think part of the surveys will get influenced by what's going on in the stock market because
Mhm.
that influences the media news and how people are feeling. But ultimately, you know, if you're sitting there and activity, you're getting lots of new orders, um, you know, you're seeing things are going well. I mean, even if the media is saying things are bad, you're probably saying, well, at least for myself, things are okay. And so there will be, they will be telling us what is mostly happening out there. And I think that there is good scope um, that can catch down there. And I think that also it does speak to that element of, you know, Is it a bull trap? Is it a bear market rally? Is it an eye of the storm? But um, I don't think that. Yeah, I think to sum it all up, I guess, is I don't think that we get off that easily. You know, once you once you take certain actions, it's hard to untake them. Like with the tariff thing, I think it's quite hard to undo that now. And like, even though they've walked back some of it, the tariffs in place are still pretty big. Um, you know, I think the sort of average is going to be working out to about 20% versus like single digits before that. So it is a massive move. And I think also the damage to supply chains, investor sentiment, economic sentiment, just the way that people understand how things are going to work now. And the geopolitical order is those are things that you can't just undo. Um, I think the damage done to the China-US relationship is, because you basically enter that economic war at a time where relations were at an all-time low.
Mm.
Um, that's not good. And they're not gonna forgive that easily. So yeah, maybe the bull case to lighten things up a little bit. Maybe they can do a lot of things that will offset that. Cutting income taxes, maybe some stimulus effects, some relief or whatever that lets you avoid recession and kind of muddle through, and then you just have stocks kind of range trading. Maybe the Fed comes in, but I think the Fed will only really come in um, once we get a bit more pain or a bit, more evident, like undeniable evidence in the data that things are in slow down. So that could be the bull case, given that we're also sentiment's quite low, but valuations still need to come down. So I think, you know, I find it much easier to argue a broad bear case there than the bull case. Although I can see, you know, as it is important to do, I can see where I can be wrong on that.
That's one of the reasons I really enjoy your work because it's concise, it's to the point, and you look at the data that's presented to you, and then make decisions or judgments based on what you can see, and that's I'll make sure that you're tagged and everything's tagged in the post that comes with Substack. So I would urge people to go and check out the chart storm at Top Down Charts because again, you're very concise with what you do. So I just want to sing your praises there, Callum, because it is,
Well,
I,
thank you.
I enjoy reading it every week, so it's really good.
Thank you. Appreciate it.
So just to summarize then, we've got this what we've covered so far. So we've had a look at obviously a multitude of charts. We've focused on the S&P 500. So we've got a 50-day moving average. It is around 5,600. So that's one thing to watch out for. We've got a lot of economic noise out there at the moment. We've got
Mm.
a bit of limbo, but as you say, you would find it easier to make a case for a broader bear market rather than being overly bullish at the moment. And all this, you know, hard data, soft data, economic sentiment, investor sentiment,
Mm.
it's pretty much pointing more so to the downside than the upside. And then on top of all that, the mantra of sell in May. Is it sell in May and stay away or sell in May and go away? You're saying actually over time,
Yeah.
that's proven
Come back
relatively
on.
unreliable.
Yeah, and come back on St. Leger's Day is apparently the full saying is so yeah, that's the other thing is and just to briefly look at it, I did a bit of deep dive on this. Yeah,
Right,
you're supposed to
perfect.
come back. You're not supposed to sell a man, go away and never come back. You're supposed to come back. So
Thanks for clarifying.
yeah. Um because yeah, like it's quite interesting if you look at the May to October, November to April periods there. So your average return even in bull markets, it's lower during that period. But bear markets, it tends to be on average negative, which you'd expect, and the percentage of the time that it was positive is yeah only 55% for bear markets, which is interesting too because it just tells you, well, okay, it doesn't work all the time either. But yeah, quite a stark um, difference there, and also just on the monthly month by month view there, the monthly returns during a bear market tend to actually be positive in April. And so, okay, I don't think we're going to quite manage to get positive in April. I think we've got a day left. Maybe we can get it positive, but
Mm.
from the bottom going up, it was a big move. So, yeah, and then it kind of gets a bit uglier in May, June, and August is the worst. But yeah, yep. And I think sell in May is probably a decent proposition this year. Um,
I would concur with that. Well,
yep.
Callum, well, I think that's a fantastic deep dive into the S&P 500. I know I've learned an awful lot from looking at those charts. And as I said at the start, apologies for podcast format listeners. I would highly urge you go and watch the video. That would be at contrariancapitalist.substack.com. I, I would like to ask Callum where people can find you. I know we've mentioned top-down charts and yourself as well. But if people do want to get in touch and follow your work, is there any other place that they can do that, or is it top-down charts the place to
Yep.
be?
Um, yeah, so well, you can look for me on Substack Notes. I make posts there fairly regularly. So just on Substack, if you search for Callum Thomas. Same thing on Twitter or LinkedIn, depending on your platform of choice. And I think that that's probably the best place to start because that's where I put the free posts out. And then if you like what I'm doing there, you can check out the other things that I'm doing.
Oh, fantastic. Well, again, I will put all those links into the show notes that come with this podcast and the video. Thank you very much for your time as well. One last question. Is there anything we haven't discussed? Is there anything we haven't looked at that you think people need to know about or need to see before we sign off?
Hmm, that's a good question. Um, well, I could probably spend another couple of hours talking about that. So, um, yeah, I mean, maybe one would be the, um, I'll see if I can bring it up, would be what I call the euphoria meter. And so it's a little sort of um, Frankenstein indicator that I've cobbled together as
Mhm.
it combines the forward PE ratio, bullish sentiment from the surveys, and the VIX, inverted and also smoothed. And what the attempt to do there is to combine the signal of three different types of information into sort of a composite market cycle indicator. And so I think that's actually been quite helpful in this past couple of years. So it gave basically a buy signal in 22,
Mhm.
and basically a sell signal or a caution signal last year. And I've been I have actually been regularly featuring this in the charts I'm having in the last couple of weeks. Because I don't tend to only update it monthly or in the middle of the month sometimes. But I think that this is from if we go on the hypothesis that this is the peaking stage of a market cycle, it's not just some one-off event risks that have been thrown into the mix. But if we think of it as a turning of the broader cycle, then we kind of want to keep track of this and um, as it makes its journey all the way back down to, you know, to the bottom end of the cycle and then turns back up again, which it will inevitably and eventually do. So I think and it's a free indicator there. I've got the link to it there, so it's kind of something that you can keep track of, and yeah, just a way to kind of keep us grounded through all the chaos and yeah, through the chaos and the bullish times. So yeah,
Definitely. Well, it's a case of watch this space. Thanks for doing that because I know
yeah,
that you're very fond of putting a bonus chart in. So I'm grateful that you've plugged that one out as well.
yeah, good call.
Callum, thank you very much for your time. I look forward to hopefully catching up later on in the year just to see what the lay of the land is. And
Yeah,
again,
yeah.
all the
Maybe we
links will
come
be in the
back in
show
November
notes.
after selling in May.
Yeah, I think I might make that the headline, the title, I think,
Exactly.
of it. But no, thank you very much for your time. Have a fantastic day and look forward to catching up soon.
Cheers. Appreciate it.